In the world of low interest rates and increasing volatility, where can investors look for consistent, dependable income that keeps pace with inflation? Please listen to our Advisor You Can Talk To podcast to listen to the insight of equity analyst Kate Austin and portfolio manager Charlie Toole as they explain the power of dividend investing. Hello, this is Steve Johnson, portfolio manager at Adviser Investments. We're here with another Advisor You Can Talk To podcast. Today, I'm lucky to be joined by Kate Austin, equity analyst, and Charlie Toole, portfolio manager of our dividend income portfolio here at Adviser Investments, to talk about a few of my favorite subjects, dividends and income. Thank you for joining me today.
Thanks, Steve.
Thanks for having us.
Now, we know interest rates, Kate, have been low now for quite some time, and as investors search for dependable and regular income, we know they have many options. Dividend-paying stocks are what you both focus on in the portfolio. So, Kate, let's get right to it. For our listeners today, what exactly are dividends?
I like it, Steve. Let's get right to it. Dividends are generally quarterly payments that are made to shareholders that hold a stock. Dividends are paid from either company profits or cash reserves. Many investors use dividends as an income stream, similar to how one would use coupon payments from a bond as an income stream. The only difference is the stock price and the dividend payment are not guaranteed. So, on one hand, hopefully the dividend payments and stock price will rise over the holding period or over your investment period, but they can also fall too, which makes them a little bit riskier than bonds, but a little less risky than non-dividend paying stocks because you get some money back each quarter.
Great, thank you for that, Kate. Charlie, why should an investor focus on owning dividend-paying stocks?
Thanks, Steve. I think it's just as simple as over the long run, dividend stocks outperform. In a study done by Ned Davis Research, they looked at dividend paying stocks and stocks that either didn't pay a dividend or stopped paying a dividend. And over the 30-year period that they looked at, the dividend paying stocks outperformed. In addition to that, those dividend paying stocks had less volatility than the non dividend payers. And as an investor, that's the best of both worlds. You get better returns and lower volatility. I think another important factor is that investors get paid a portion of the company's profits, as Kate mentioned. And when you're in retirement, you need to pay your bills, and dividends can be a large part of your income in retirement. So we focus on companies that grow their dividends, so you not only get the income, but you also get a raise every year.
Great. Well, thank you for that answer. Kate, Charlie mentioned something there in particular about companies that are growing their dividends. Are there any other particular characteristics you like to focus on?
Definitely. So, if you think about companies that pay dividends, each quarter they're paying out cash to investors. So, these companies need to be very strong fundamentally to have cash coming out of the business every single quarter. So, they definitely need strong free cash flow. That's just basically the cash that the company is producing by selling their goods after reinvesting back into the business. But cash flow is not enough, right? It doesn't just fall out of the sky. So you have to think about, is the revenue growing? How are the earnings growing? How strong are the products? All those are really important. But it's also important on the flip side to make sure that they're growing, but they also don't have too much debt, because debt can really weigh down a company. As shareholders, we're really beholden to management teams to do best by us. So we need to make sure that management is focused on paying and raising the dividend, but also making sure that debt isn't ballooning. So we need to look at the fundamental data to make sure the business is strong enough for this cash to be coming out of the business every quarter and into our pockets.
Well, it's always good to have extra cash, that's for sure. Charlie, when a lot is written today about owning FANG stocks, and really, I think investors are so focused now on technology. In your experience, are there certain sectors that are better for dividend-paying stocks?
Well, Steve, I think that a lot of sectors, or a lot of people, when they think dividends, they gravitate towards some traditional sectors. And I play the game Monopoly with my kids a lot, and that's an old school game. It's a game that's set back certainly a long time ago. And if you look at that game, there's a lot of traditional dividend sectors there: real estate, utilities, railroads. But in today's market, all sectors have dividend paying stocks, even growth sectors like you mentioned, technology and biotechnology. And for me and for Kate and for you, it's all about the individual company that we're investing in. We'd rather own a high quality company in any sector rather than just owning all the companies in the utilities sector, for example. So it gets back to some of those characteristics that Kate mentioned. We really like companies that grow their dividend, and you can get that in just about any sector in the market today.
Great. Thank you, Charlie. Yes, you definitely have a lot more patience than I do. My Monopoly playing skills are not very good. So, Kate, Charlie mentioned sectors like utilities, in real estate, some of the more traditional ones. In my experience, I see a lot of investors gravitate to the high yielders. Is this a good strategy?
So, this is actually a question that we get very often. In this instance, it's one of those where I think it's like the dividend yield pigs get fat and dividend yield hogs get slaughtered. A dividend yield is definitely an important metric, but it's really not the only one to look at. Dividend yield itself is a valuation tool and not really indicative of the fundamental health of the company and business that I was talking about before. So if you think of dividend yield, it's really just a fraction with the total annual dividend at the top on the numerator divided by the stock price. So if the stock price falls, keeping everything else the same, the yield will go up. But nothing about the dividend payout has actually changed, right? So the dividend yield is always highest before the dividend itself gets cut. And we've seen the dividend yield spike sometimes 6 to 9% before a cut is announced. Now, if you're just looking at dividend yield, you'll think to yourself, wow, a 6% dividend yield, a 9% dividend yield, that's huge, that's great. But if you look at the underlying fundamentals of the business, or maybe some negative headlines or something like that, it can often point to why the dividend yield is spiking and then, of course, possibly getting cut later. But so we definitely prefer a lower yield that's steady and growing, similar to what Charlie was saying, where we can get some stock price appreciation along the way, rather than a dividend yield that's really high and a little bit shaky.
Yeah, and especially in these times where companies are going through some difficult periods, your point is well taken there. Charlie, I know you might be a little biased with this question, Charlie, but I'm going to ask it anyway. I know that you're a portfolio manager of stocks, but where interest rates are right now, should a client own dividend paying stocks or bonds?
Well, Steve, I definitely am a little bit biased when it comes to this question, but I don't think it needs to be one or the other. And most clients that we work with own a combination of stocks and bonds in their accounts. But I do believe that dividend stocks have a place in everyone's stock portfolio. And we've already talked about the reasons why with the better performance and the lower volatility. But given today's low rate environment, it's really tough to get income from bonds. We've seen treasury yields, they've been low for many years. And in fact, they've been below 2% and even below 1%. But if you look at a dividend growth stock like Johnson & Johnson, the dividend yield of that stock has been between 2.5% and 3% over that time. It's not a high yielder like Kate was talking about with a yield of 6 to 9%, but it's a solid company that's been growing its dividend every year. And for me, I'd rather own Johnson & Johnson for 10 years instead of owning the US Treasury. Going to get more income, and you have the possibility of getting getting more principal appreciation. There's certainly going to be a lot more fluctuation in Johnson & Johnson stock price over the next 10 years, but that gets back to how we view bonds and how to use them in a portfolio. Bonds are more of a shock absorber. They're very stable in price and they do pay the income, and that reduce the overall risk of an account. So if you want to reduce risk, reduce volatility, adding more bonds to your portfolio is the way to do that.
Well, thank you. Yeah, I think we're going to have a lot more conversations about this topic, especially because, as you mentioned, yields are so low. So, Kate, it's been said that I get to be a little cranky and definitely old fashioned. Are there certain clients better suited for this type of strategy? Are dividends just for cranky people like me?
I love this, Steve. No. So the simple answer is no. Dividends are really great for everyone, and kind of like Charlie was saying, they're really good in almost every portfolio, almost like a bond. A lot of retirees do like dividends, which is why they kind of get this old-fashioned, gray-haired reputation. Because, like we were talking about, they can be used as an income stream. But really, it's also too because it's typically more mature companies that pay a dividend, so that doesn't help. It gets the gray-haired reputation on both sides. But dividend-paying companies are really a good investment for anyone. Any company that's paying out cash each quarter is probably a pretty strong company, or they wouldn't or couldn't pay a dividend, right? You can't pour from an empty cup. But dividend paying companies have this great benefit that Charlie was talking about, as they tend to outperform in a bull market or an up market and protect on the downside in a bear market or a down market. And because of this, they tend to recover faster after the bear market bottoms too. So I think this is something that all investors can agree upon is pretty nice, and we would want to have this in our portfolio. And just because a company pays a dividend doesn't mean it's washed up really anything but. There are a lot of companies that do pay a dividend that are doing very cutting edge work. For example, Pfizer is working on a coronavirus vaccine. Microsoft is doing a ton of stuff with machine learning, the cloud, AI, all super cutting edge things. So I would say that dividend paying stocks are not old fashioned per se. I would say that they're just less volatile. And that is, I think, that something that everyone can really appreciate and agree upon is pretty nice to have in your portfolio instead of just holding on to it like grandma and grandpa.
No, exactly, especially with that volatility. And that volatility, Charlie, brings me to another point here and a question for you. One of the problems that I have as an investor, and I'm doing this for years, is when do I sell? And so, especially in this period where we're experiencing more volatility, how do you look at a company and decide when to get rid of it out of your portfolio?
Yeah, that's a great point and a great question, Steve, because I think there's a lot of work and all the discussion is around what and when to buy. Everybody has their stock picks, the stocks that you should buy, but nobody really tells you or talks about when to sell a stock. And selling is just as important as buying. Really, the most important or the primary one is we look at the reason why we purchased the stock in the first place. Has that reason changed? Has the reason for buying it played out? So, for example, Kate mentioned healthcare stocks and developing drugs. You might purchase a stock because they have a strong pipeline of new drugs that are going to come to the market. Well, once those drugs have come to the market and have grown and taken market share, there might be competitors that are launching rival drugs that might eat into the profits of that company. And that could just be a reason, a changing of the thesis, the investment thesis, if you will. So if you have a change of the thesis or the reason why you bought the stock isn't there anymore, that's certainly a reason to look at selling. One of the other reasons we look at selling is there just might be a better opportunity out there. You've owned a stock and it's done very well for your holding period, but it's gone up, and now there might be another stock that is at a lower price, a better yield, having a better opportunity. So that's another reason to sell. And finally, the other reason is your personal situation changes. You could be an investor in your 50s, quite a few years from retirement, and you can afford to be aggressive and own more stocks. But as you get older and you get closer to retirement, you'll probably want to reduce your risk, and that's a reason to sell some of your stocks and reposition it into bonds.
Well, boy, Charlie and Kate, I know every time I listen to both of you, I learn a lot. So thank you both for joining me today. As you heard, dividends play a vital role in a portfolio, especially in this low rate environment. So this has been Steve Johnson from Adviser Investments, thanking you for listening to the Advisor You Can Talk To podcast. If you enjoyed this conversation, please subscribe and review our show. You can visit us at adviserinvestments.com/podcasts. Your feedback is always welcome and encouraged. And if you have any questions on dividends or dividend investing that you would like us to explore, please email us at info@adviserinvestments.com. Thank you for listening.